So good day, everybody. This is Gary London. I'm senior principal of London Moeder Advisors, and we have a pretty interesting group of people here with us today to talk about the apartment market, particularly in the San Diego region, past, present, and future. What's going on in the market? What's been going on? What the future prospects are, both from a market perspective and from an investment perspective. So in that regard, I've invited two veterans of the apartment business to chat with us. I've also invited my senior analyst, Robert Martinez, who just produced a report on the apartment market, and I'm going to have him take this over in a minute and just walk us through some of the highlights of that report just to set the table for this conversation. But before I do that, let me introduce Jim Stewart and Jeff Castellaw to introduce themselves. Tell us who you are, guys. Maybe Jim, you want to start?
All right. I'm Jim Stewart, manager of San Diego Apartment Investors. We're a local apartment syndication company, and we've been syndicating San Diego area apartments for over 25 years. My college degrees in real estate, and in a previous life, I was a cost auditor and negotiator for Goodrich Aerospace. And in addition, I served on the Pacific Trust Credit Union Supervisory Committee. I've owned and managed my own property since 1976 or so. So I've seen a few cycles.
What kind of properties are they? What size properties are they, and where are they, just in general?
From early on, I started off with smaller ones, 2 to 4 units, but it really spans we've got a 62 unit and a 28 unit. A lot of 8 and 9 unit buildings that we've done. So, and primarily North Park, East San Diego, El Cajon, Hillcrest.
So your portfolio is small projects in pretty urban areas
Yes.
around the region. Good. Okay.
I'm Jeff Castellaw. I'm president of San Diego Apartment Brokers and So California Living Property Management. We do investment grade brokerage, multifamily brokerage, and apartment management. I've been doing this since 1980. I've seen a few cycles like Jim, and ups and downs, the expansion, contraction, and we're interested right now, Jim and I, in doing some additional syndications going forward. So we're very interested in what the apartment market is going through right now. And so we brought you guys in to do some data research and try and help us get our heads around the marketplace and the production and the supply and so forth. So,
Okay. Well, in that regard, we did that work,
yeah.
and we produced a report and a lot of charts and tables, and I thought that they were pretty interesting. So I think at this point in the conversation, let me just turn the conversation over to Bobby, Robert Martinez, who is the principal analyst on this assignment. And maybe, Bobby, you can share the screen and walk us through the findings of the research. And maybe I'll interrupt you. We'll see how it goes.
Okay. So we took a look at quite a few different angles of the market, much more than in depth than what we're presenting here. But I just want to give an overview of what we looked at and kind of what the results have been. Most of these charts and tables are going to be from 2000 to present. Kind of took us through the run up to the 2008 recession, the effects of that, and then the recovery, and then where we are today. Okay, so this chart shows the supply of apartments, market rate apartments in San Diego County from the first quarter of 2000 to the middle of this year. And you can see that in the first 15 years of this time period, units increased at 15.7%. In the last 10 years at 15.4%. That's a total increase of about 71,000 units. A significant increase in units, and you can see the increase in projects as well.
And this is for the entire region.
Correct.
Okay.
Looking at occupancy, this chart is a little bit deceiving because it looks like we're jumping all over the place. But if you really kind of dig into it, you'll see that the county is really kind of the low, which was 2009, 2010, kind of the bottom of that recession. But it really was still over 94%, which is close to full occupancy. And then we've kind of ranged, we've got an average of 95.4, which is 95% typically is considered fully occupied.
Yeah, and I would only comment here that when we're doing pro forma feasibility studies on apartment projects, we're generally comfortable with stabilized occupancy at any number over 90%. Sometimes even a little bit less. So when we see numbers, we're a little out of scale here because these numbers are all reflecting fairly full occupancy throughout San Diego County. It fluctuates by neighborhood, and we're going to get into that in a few minutes. But the reality is that when you see, as we see throughout the last 25 years, that we've got occupancies that are hovering, in the 95% range, sometimes a little over, sometimes a little under. That's pretty much the same. The market is no matter what we've added in terms of those 70,000 units, we've been able to fill them.
Well, that makes it very stable and predictable.
It does. The demand for all housing in San Diego region is pretty much insatiable just because there's such a big imbalance of supply and demand in the marketplace. And that's no different in the apartment market than it is in the for sale housing market. And as we sort of have entered an era where housing prices have continued to go up and housing ownership becomes a lower percentage of the whole housing game in terms of who can own them, and housing becomes just more elusive to purchase, people rent. And so that pretty much solidifies the rental market now and probably going forward for the foreseeable future. I really don't see a time where we're going to ever be able to add enough inventory to make up that sort of gap between supply and demand.
Things that can affect result in these fluctuations are not only the recession that we had, but increases in inventory. So large projects that are entering the market will affect occupancy because they take some time to lease up. If you're going to drop 500 units, it's going to take at least a year, if not two, to stabilize those projects. So that can have an effect. Even when you've got 250,000 units in the county, it still will show up in some of these fluctuations. So that's part of it as well.
My thought there, however, is that those large projects are pretty much centered in the big urban centers of San Diego, downtown, UTC, Mission Valley, just to name the three most obvious. When you're talking about the kind of portfolios that Jim and Jeff typically deal with, those markets, that's a whole different market. The apartment market is sort of bifurcated, at least. That's a whole different market that really probably doesn't see any kind of fluctuation, regardless of the amount of additions you see in those core markets.
Gary, this is an average too, and I noticed in your report, if the newer apartments, the upper end, they're running close to 10% vacancy at this time, and kind of the more moderately priced apartments, the ones that we trade in, used apartments in the inner suburban neighborhoods, we're rarely at 3%. Our vacancy generally is we're sub 5% vacancy all the time.
Yeah.
So,
And
but this
again,
is an average. So I guess this is, countywide average 95% occupancy is pretty remarkable.
yeah. And you've expressed it in another and perhaps more persuasive way that, again, these big projects and these big in the big portions of our market tend to sway the numbers, but despite that, it's a pretty stable regional market.
Mm-hmm.
This one is we're looking at rents, again, market rate only, average asking rents. Pretty big increase between 2000 and 2015. 45, more than 45%. Who even remembers $1,154 as an average rent?
I
As
do.
we were 25 years ago.
Sorry, I'm getting old, I guess. I'll tell you a little story. Jim and I did a syndication years ago, and I just tortured myself whether I could get $400 a month for a one bedroom. I wanted to put it on my perform at 395. We finally landed at 410 or something. So
So do you know why a goldfish is always happy?
why?
They have no memory. So yeah, we can all we all four of us share the commonality of almost white hair, and we've seen a few cycles, haven't we?
Yes, we
So
have.
you can go back, but it never ceases to amaze me when I look at these numbers that Bobby put together, the latest numbers, the $2,500 number there. It feels like a mortgage, and and this sort of what almost distinguishes, say, we baby boomers compared to younger generations. They're paying about the same per monthly as probably we are on our mortgages. And we're getting a lot more bang for our buck in terms of the kind of housing that we have and the fact that we have home ownership and so forth. And that's a big issue in society today, and no less an issue in San Diego, where we have other charts that demonstrate how whatever number of units we deliver in any given year, by far the largest percentage of those units are apartment deliveries or not for sale housing deliveries. So, and it's a challenge, it is a challenge at these increasing rent levels to for people to afford them. But you got to live somewhere, so you don't have to make a down payment on an apartment, right? Or
Just a security deposit, I guess. Yep.
Yep.
Interesting.
Carry on, Bobby.
Interesting.
It's interesting that most recently, if you look here in this 2021, 2022 time period, you see the increase in average asking rents increased pretty sharply. It's pretty steep right here. This is a long time period, so it's a little hard to see to see. But each quarter in here was about 7.5% increases year
What do you
over
attribute
year.
that to?
I think honestly, I don't really have a good explanation for it.
Isn't this the post-COVID period as well?
It is. It is.
That might have something to do with it. People were hunkered down, and then when we got freedom again, we started we started to move out of where we were and create a more dynamic market. Probably that had a lot to do with it.
Gary, I remember a period in the early 80s. We raised rents 15% a year for 3 straight years across the board. It was just this, I think it was 81 or 82 for 3 years. The fourth year really hurt. That was one too many. And boy, did we have indigestion from that. But it seems to me, going back, that rents kind of just flatline or they hover, and then all of a sudden pressure builds in the market and just pushes these rents up, kind of like it did during this period. So the graph winds up looking more like a stair step than a nice linear relationship. So I think maybe the way the market functions, the economics of it all, it has to get to the point where rents are going up and then they justify new building, and then the builders come in and they overbuild, and excessive profits, excessive competition, and we go through this cycle again,
Yeah.
Anyway.
That is pretty much how it plays out in most of these cycles, yeah.
And you can
Seems
see
to me we've had a heck of a run, but these rents have definitely started to flatten out the last year or so. We've noticed.
I was just going to say, yeah, you can see in these last few quarters, going back to, I think that's late 2023, where it's really kind of just bouncing around there, around that $2,500 month mark.
And I've been anticipating this for the last couple of years, that what I call reaching peak revenue levels, and that it's just a function of we're in the cycle right now. We can peak out, for people to basically be able to afford rents. This contrasts with what it costs to deliver a new apartment project today. And essentially every cost of production has gone up. Land, labor, capital, materials, those are the factors of production. They've all gone up in cost, but revenues are now, as we're indicating, appear to be flatlining, which means that projects aren't going to get built for the foreseeable future, which will impact first occupancies as high as they are. They can't get much closer to 100% than they are, but they're going to stay high, at least inevitably for the foreseeable future. And at some point, we're going to have to raise revenues, see revenue raises again throughout the region, which will ultimately justify the development of new apartment projects. But it takes some time for that dynamic to play out. So for the foreseeable future, I do see a sort of a flat rent period until other factors start to come in play. The other part of this is over the next couple of years, we have a very uncertain view of what our economic prospects are. We don't know what the impact of tariffs are going to be, the impact of relatively high interest rates, inflation rearing its ugly head again. Maybe we're entering a period of stagflation. These could all have an impact on what people can and are willing to pay for their housing costs. So these are things that we think about.
Okay, now we're looking at unit deliveries since 2000. They're trending upward since we hit the bottom of only 254 units delivered. Market rate again, and in 2024, almost 5,000 units delivered. In this 25-year span, we've averaged 2,776 units delivered per year.
Do we have any idea what it is so far in 2025?
I probably have that somewhere. I don't have it anywhere on this slide.
We might be.
I don't know if we're going to get back to the 5,000 unit point, because like you said, there's a lot of projects have if they started a phased approach, they are holding off on future phases, and some of the big projects are just not happening. They're fully approved, fully permitted, but costs are keeping them from moving forward.
Yeah, so if you have a permitted project and you already have a construction loan and there's cranes in the air, you're going to complete the project at this point.
Correct.
But if you're not past the point of no return, you're probably going to hold off.
I would think so, Gary. From what I hear from the brokerage community, most of these new projects are probably underwater. If you took their market value today and looked at it against their costs, so you'd almost have to. It'd be a suicide mission to launch one of these today because, like you said, we don't know the future. But right now, these market values, there's not a lot of buyers out there right now because of interest rates. So, for developers to tee it up now would be. I mean, maybe there's a few out there with their own money, but I don't think the lenders are going to want to finance these. Seems to me.
No, we're pretty much seeing the same thing.
Yep.
So we looked at growth in the county by the type of units, and we put together some of the smaller units, what we like to call non-family type units, studios and one beds, and then the two plus bedroom units, more family oriented, something you can put an actual family in. But you see, back in the beginning of the 2000s, 2000 to 2005. 62% were studios and ones, 37%. And then we flipped a little bit. In the next 15 years or so, I'm sorry, yeah, the next 10 years, we were building more 2 bedrooms, more family type units. And in the last, since 2015, it's shifted back, and we're really producing mostly studios and 1 beds, again, countywide, to where we're almost back to where we were in the early 2000s. And that can potentially be problematic because are we really serving the entire demographic that wants to live in a rental home? We're kind of really focusing on young singles or young couple professionals, and the families are starting to go by the wayside a little bit.
Yeah, these the apartments aren't typically the home of families in San Diego, at least. I mean, this isn't Manhattan. So I think the point being is that there's a continuing significant and high demand for this kind of housing, but apartments are not going to deliver family housing, and I don't expect that's going to change. I mean, I don't think we're going to see unit counts go up in terms of new construction. I'm sorry, bedroom counts go up in new construction simply because the value ratio or the price per square foot that we can achieve in terms of apartment revenue is higher with smaller units. That's always the case. So in terms of just maxing out your profit and the feasibility of the project, the unit mix probably is going to stay pretty much dominantly smaller units, maxing out at 2 bedrooms. We're not going to see a lot of 3s and 4s get built in the future.
Here's where we're at under construction. We do have over 9,000 units under construction as of the second quarter. But some of those are not going to be done by the end of the year. So, that's not that 9,000. Those 9,000 units are not going to deliver in 2025. So that's
And no matter what, the number's down from last year.
It's down. It is down from last year, but it's still relatively high compared to, the 2004, 2005. I think our low in the fourth quarter of 2004 was just a little over 2,000 units. And then we had some quarters that were over 10,000 units. So that's still a significant amount of units that are eventually going to be in the market.
Okay.
Gary, Robert, just a question. The units under construction, are those units pretty much beyond the point of no return? They're going to hit the market? Or are those some of the ones that might have permits and decided to shelve them for the time being? Or do you know?
My inclination is that the majority of these are actually going to show up and complete. Sometimes they'll put something under construction that has only started grading, maybe putting in utilities.
Right.
And then that's a lot easier to stop prior to pouring concrete for supports and getting sticks in the air.
Right. So the 9,200 units approximate, do you expect that to be hitting the market, not all this year, but maybe this year, next year, and some the following year, or do you have a feel for that?
Probably, well, we're already mid-October. So
yeah,
some of these this year, a good number of them next year. So next year looks like it could be a good year for deliveries.
We were looking at the absorption rate part of your report. I guess want to get to that later. It's an interesting figure. It looks like roughly 3,600 units at the current rate, 3,600 plus or minus units absorbed per year. So I was thinking we probably have another couple of years of absorption, flat line on rents, kind of a soft market going forward for a couple more years, it looks like. And, I was looking at the absorption rate and the under construction and trying to get a feel for when we might reach the point where we've pretty much absorbed the last of this building boom. I noticed the pipeline looks about empty. I think 700 units in the pipeline, which is not insignificant. So it looks like to me a couple of years, maybe 2.5 years, a year and a half. It's hard to predict, but that's kind of the way the numbers look. What do you think, Gary?
Well, I mean, I see my developer clients more or less sitting on their hands at this point, unable to move forward with deals, either because they smell the market softening for them, but also because as I said earlier, the cost, particularly the capital costs, have risen to an extent where projects are just not penciling right now. They will at some new cycle sometime into the future. Whether that future is a year or 3 years from now, I don't know. But the new supply is definitely going to be limited for the next couple of years, and that will impact existing supply in terms of increasing pressure on occupancies and absorption, and maybe eventually lease rates. But as I said earlier, the lease rate portion is a little bit more complicated because we may have reached peak affordability in this market. So if the economy is slowing down, I don't see how there can be a lot of movement in that regard for the next couple of years.
Right.
Is this
I
your
do have
last one,
that-
Bobby?
I do have that page of the report.
Go for it.
I can put that up here
Sure.
for you. So yeah, this is the chart you were talking about. And it's quarterly here, so there's a large amount of fluctuation here. But yeah, 1,100 units absorbed in the second quarter of 2025, which historically is good. I mean, in this 20-year span or 25-year span, I average about 627 units a quarter. So in the last 12 months or more, last 5 quarters, we're above average.
Either of you guys have a different interpretation of where we're at in terms of the market or the immediate future than I've just offered up?
Well, we're all looking into the future. It's really hard to say. There's so much uncertainty right now. I know in order for us to deal with the uncertainty of all of this, we're coming in and just paying cash for the apartments we're syndicating. We're not using any debt. So depending, because we don't know exactly how things are going to turn out. One of my hunches, for what it's worth, is I think we're probably going to have higher inflation than we've experienced as a nation, maybe the late 70s, because of our national debt and our inability, as a government to amortize it and pay it off. I don't know any other solution other than to monetize it and translate that inflation. So I'm thinking maybe down the road we might see some inflation kicking in here, which could accelerate there's real and then nominal rent growth. I mean, if inflation could take all of these numbers and change them, shift them upwards with inflation. So I don't know. It looks like to me, on average, we should fully absorb the units under construction in a couple of years, maybe a little less or a little more. And at that point, we're going to have a period of short supply because the pipeline's empty. And that's going to build pressure on rents and push them up again. And inflation might take care of the affordability gap.
Yeah.
But my opinion is as good as the next guy at the bar. I don't know what's going to happen, but it just seemed logical to me. I don't see this country getting out of its sovereign debt issue without inflation. Gary, you're the economist. What do you think about that?
Well, I guess my view is that I see stagflation coming. I hope I'm wrong, but I see a combination of inflation and just across the board slower economic growth, slower employment growth, which is the very definition of stagflation. If that happens, it's very difficult for the feds to deal with because they're at cross purposes. So, but the other thing that resonated in what you just said is the term uncertainty. I would also add the term chaos. I mean, there's just, when today we got a tariff, tomorrow we don't. That country gets it, this country gets a rise. I mean, that kind of stuff, uh, as it starts to filter through the market, just creates um, a, a lot of slowness in decision making, I guess is the best way to put it. People
Mhm.
don't know how to react, whether you're in the stock market or whether you're in the housing market, whether you want to change jobs, quit your job, move to a different area. I mean, these things are all impacted when the economy starts to slow. And even the president said, whether you agree with his politics or not, or what he's doing or not, he said, we're probably going to be experiencing a period of pain before we get to the economic promised land, whatever that is. So I think we're starting to feel that. I think we're starting to see inflation. I think that tariffs are impacting it. I think immigration or lack thereof is impacting it. I think to some extent AI is impacting it. This is an economy that is in some kind of a transition or not. And from the perspective of the housing market, it just to some extent, it creates rigor mortis. People sort of freeze up, whether they're running companies or just people uh, doing their jobs or delaying decisions as to whether they want to move to another job or another region or that sort of thing. The good news with respect to San Diego is that we're a very diversified economy, no slowdown in one sector. I mean, we're in the middle of a government shutdown right now. We've got a big government sector here, mostly military, and apparently they're still getting paid. But even with the giant footprint of the government in this region, we still haven't yet felt uh, that much the impact of the shutdown, and that just goes to the fact that some people, a big chunk of the employment sector is in military and government, but an equally big chunk is just in small businesses or in bioscience or in high technology. So a lot has to go wrong for our region to go wrong economically, and so diversification is kind of our blessing. I am troubled by a slowing down of population growth. We're sort of reaching population stabilization here. On the other hand, we still have companies that are growing, particularly in the technology sector. So it's kind of a mixed bag, even in light of a sort of dicey economy now and going forward for the next couple of years. And I don't see that negatively impacting existing apartment inventory, the kind that you guys trade in and hold. I see it impacting new development, new projects, some of the core areas where you have big apartment projects that require lots of absorption because they have a lot of rental units. And the stuff that you're dealing with, I don't see the impact.
Interesting. Yeah, I trying to sort through all of the cross currents right now. It seems to me that it's just an environment where it's a good idea to be on the safe side. Hence we're going in all equity, so no matter what happens, we'll just ride it out. But I think
And
the
then, and
back
then,
end,
and then do you refinance later? Is that the strategy?
Well, we're going to be
well,
flexible.
yeah.
So we might
Go ahead, Jim.
refinance, but just depending on the conditions, we could refinance or trade up or sit still. So it's the flexibility is the key to one of the keys to what we're offering.
So when you're putting more equity in the deal, that dummies down the returns, but it creates the safety. And then you
Yes,
can always repair that later when you either trade or refinance or whatever it is you do.
If
yes,
we hit the market just right, Sorry to interrupt you there, Jim.
Oh, no, go ahead.
I was going to jump in because I want to explain to Gary the concept really is if down the road a few years we do in fact hit this tightened rental market due to the pipeline being empty and the uncertainty, and you combo that with the economy on the recovery with inflation underneath it, and we could hit that period where it's really great for real estate people. And if we hit a market that good, then we can take the free and clear apartment we have today and leverage it up for, into a 35, 45% equity position and basically use the advantage of leverage later when the opportunity presents itself rather
Right.
than now when it really doesn't make any sense.
Right. That's sort of what I was inferring. That's
Yeah.
you pull the money out, pay your investors, and uh, keep it going, but do it on a leverage basis.
And maybe interest rates will come back down too. I mean, they have about doubled since the lows. Now, the lows were very low, that's true, but the cost of money is still what for apartments today in the mid fives, upper fives, and they were not long ago, they were in the low sixes. So, cap rates are still what, 4 to 5,
Yeah, they're incredibly
real
low.
cap
So
rates.
yeah,
So we just sold a couple of apartments, and they went out at a real cap rate of 4 for an older building close to the beach, and then another one, Ocean Beach, and then another one in La Mesa went out with a real cap rate 5. So I think
yeah,
that's where the market is, but there are not a lot of apartment buyers right now.
no. Well, I think that we're in the new reality with respect to interest rates. Pick your poison, whether it's takeouts or construction loans or a bridge or anything in between. I think that um, we'll hover. We could see some lowered rates, but not significantly. We're not going to get back to the rates we saw a few years ago in the immediate post-COVID period. That was a low bubble point that, if there is such a term, that I don't think we're going to hit again.
I think you're probably right. I remember when Paul Volcker said one day you'll see 6% mortgage rates, and everybody laughed at him because he was being too optimistic. So things change over time,
That's when it was 18%, right?
FHA was at 17. And yeah, right.
See, I told you weren't a goldfish. The because you're dating yourself here. You're going back 40 years now.
Yeah, I had a commercial guy say, "Yeah, this building of mine I just built, it's full. It's just everybody's invisible. You can't
Yeah.
see anybody."
Yeah.
It was horrible for builders. But right now, 5.5, 6 seems too high. I don't get it.
Well, it's funny. You're
But if,
advertently or inadvertently making a really important kind of global point, which is that in the long term, uh, real estate assets are good to hold. They go up, they create value. They're good in a portfolio. And you have to sort of look away. This is what the stock people tell us too, right? You got to sort of look away during, when things are changing rapidly. Of course, the difference between real estate and stocks is they measure in terms of seconds, hours, minutes. We measure in terms of quarters, years, and decades in terms of our cycle. So, by the very nature of the asset, we look long term. And if you look long term, you're looking backward, but if you look forward long term, these assets are always going to increase in value, particularly in a market like San Diego, which for lots of reasons, I talked about economic diversification, but even if you take something as weird in this type of a conversation as climate change. I've been calling San Diego region, for that matter, all of Southern California, the climate change Goldilocks zone, because we are probably going to be the recipient of a lot of housing demand of all types of people that want to be here instead of places that are hot or are impacted by really uncertain and bad weather. I mean, I think these things do impact the market and make our market fairly safe, particularly in the kind of neighborhoods that you guys trade in, which are, bona fide, suburban urban neighborhoods that have stood the test of time in terms of their quality of life and the sanctity of the real estate holdings that are there. So I think as long as you trade conservatively and hold conservatively, you're probably going to be doing pretty good and probably get pretty good results for your investors.
Well, Gary, that's a good point. Our average rent is probably around 2,200 a month. Our average rent, which is below the regional average. And we're happy at that level. We're making money. We're just happy if, they go up a few percentage points a year, that's great. But that's the point in the market that you just can't build any of that.
Right.
You can't build a two-bedroom apartment and rent it out for $2,400 a month. And that I don't think is ever going to change. And so the ability to provide that kind of housing is practically nil in San Diego. Now, the market will take care of itself in terms of overbuilding at the upper end. And we do have some effect, compression coming down from the upper end. But essentially, I just think that maybe San Diego is just not going to ever be able to have real affordable housing for the working force. The lower end might just have to go to Tijuana or Riverside, I guess.
Well, to some
Unless
extent,
somebody
they
can come
already
up with
are.
the new idea.
We have this isn't in the study, I don't think, but we have about 120,000 vehicles coming and going every day from places like Riverside, Tijuana, and Orange County. People who live elsewhere work here, so they already sort of vote with their feet in terms of, I guess, with their wheels, in terms of where they can afford or wish to live, and that continues to be a struggle because in San Diego, there's just so little developable property that's available. So it's always um, creating a tight market, regardless of the point in cycle that we're in. And I'm fighting that battle daily, talking to policymakers, trying to get them to permit new housing and new housing types in new areas. And it's tough because the tension in the land use market is, yes, we need more housing and pricing's going up, be it lease rate or for sale. But people don't want new neighbors. So there's always pushback. And that's the kind of tension that is part of just the nature of being human. And we deal with that all the time in San Diego. The bottom line for guys like you that own real properties and that you rent out to tenants, it just means the demand will always be there regardless of the point in cycle.
Yeah, it's an interesting topic. I don't know if we're supposed to be talking too much about affordability, but it just seems to me that because if you look at the economics of construction and the shortage of land and all the regulations, it just seems like maybe the problem is not that we can't produce affordable housing, it's that real wages have been in decline for two generations. And maybe that's the missing link here. And I know that's a theoretical question, but real wages on the decline for two generations, that's a problem.
Yeah, there's a real restructuring going on in terms of how we're employed and how we pay people and where we're employed. I mean, that we're in the midst of a whole shift in our economy right now. If you look at it from 30,000 feet, it might be obvious, but if you're in it, what most consumers are experiencing is a daily struggle in what kind of work they can do, where they work, in all the costs of living right now. It's more problematic than I've seen it in years and years.
Yeah. Yeah. It's funny, we underwrite tenants all the time, and it still kind of shocks me that we're seeing usually it's two incomes that are applying for a job. Either they're a married couple or they're just living together, or sometimes roommates. But Incomes of $10,000 a month is common, 10,
Oh, yeah.
$12,000 a month, in common amongst people that are renting an apartment in North Park or Ocean Beach or La Mesa. You know, you get a little further into the inland markets like Escondido or Spring Valley, and you get more into the real blue collar, uh, and prices tend to get stickier there. But it's interesting to me. I the goldfish, I remember when, uh, you know, $1,000 a month was a pretty good income, actually. Been a
Yeah.
while.
Well, I always used to tease my father. I knew I could tell the generational difference when my car payment was higher than his house payment. That happened
No,
years
I
ago.
don't. That's funny.
Yeah. Jim, you have anything to add before we sign off?
I think we've covered it pretty well.
Okay. Bobby, thank you for your contribution to the report and the conversation. And I wish you guys a lot of luck going forward. I don't really think you need it. I think your strategy is spot on. I like being conservative. I like being in apartments. I like being in San Diego. I like being in the submarkets that you're in. I think you've hit it on all cylinders. So while I wish you luck, I think you don't need my luck. I think you're doing all the right things.
All right. Thank you very much.
All right, you guys. Take care.
Thank you very much, Gary.
You're
Take care.
welcome. Okay.
Thank you,
Bye-bye.
gentlemen.